Welcome to episode number 30 of Daily Market Mastery with me, Christian Rauchwald. I'm sorry I'm a minute late. I was finishing up an email and completely missed the time. I still need to fire up a little bit of software so that we're actually ready and good to go. And can actually do some analysis. As always, in our episodes of Daily Market Mastery, we are using Elliott Wave Theory or the Elliott Wave Principle to try to forecast market movements in specific stock or indices, basically to better manage my eToro popular investor portfolio that you can check out by following the link that's visible on the screen and pinned in the chat, as well in the stream description down below. Now, yesterday we looked at the Dow Jones Industrial Averages, taking advantage of the latest Elliott Wave theories that you can also find by following the links to the Elliott Wave book in the description down below. And so that's ready. Yeah. And yeah, with that, actually, let's just jump to the screen. So pushing that button here. So yesterday, I said we looked at the Dow Jones Industrial Averages, and we actually used, as said, the information provided by the Elliott Wave theories from elliottwave.com to label it like this, which would indicate that we're in the beginning of a third wave, which would indicate that we can now basically sell the Dow Jones Industrial indices, industrial averages, short. Yeah, and to do that, we got a position now yesterday in the ETF that counter trends it, so the SDAO. And basically it opened with +2 yesterday when we entered, and we had to pay some spread. We'll have to see how it goes the next couple of days. We actually had a positive day today, yesterday, unfortunately not enough to make May turn green. However, considering what I shared during the last couple of episodes, I actually expect that June, July, and moving forward, it will have a couple of green months and actually finish the year in profit. I have to point out, however, as usual, that everything that I share in this live stream / video, depending if you're watching it now or watching it later, is my personal opinion and in no way professional or financial advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. Yeah, so I'm just sharing my opinion based on my analysis and the information I have available. It doesn't mean that it's right, that I'm always right, or that it's the right thing for you to do. Yeah. Anyway, so I'm confident that we will probably this year not end it with record profits. So for the last 3 years since I started the portfolio, I've actually been able to end every year better than the last with like quite decent performance. I don't think that will be the case this year, but I'm still confident that we will outperform the markets. That said, so today we're going to look at the Russell. Do I already have it here? That would be RT. Let's sort it. Nope. So at the Russell 2000, because we also have the information, should be this one. There we go, Russell. Oh, there it is, RUT. Yep. So because that one we also got information on based on the Elliott Wave theories, then we obviously want to take advantage of that information. Now, if we were to short that one, we would actually say, okay, we are going to get the SRTI ETF to invest in a counter trend. Now, the short story here is that the same thing, according to elliottwave.com, that we're looking at wave 1, 2. So I don't know where. Yeah, I'm just going to throw them here right now. And I need to scroll a little bit and move them. So move this. So basically, we're looking for correction. And very often we know that the corrective wave 2 will correct into the area of wave 4 of the impulse wave of a lower degree. Now, in the Russell, that would indicate, if we roughly throw that on the chart, that this would be 1, 2. Potentially, this might be 3, 4. And then here we have a fifth wave. Yeah, we would have to check, but it probably checks out that we then have 1, 2, 3, 4, 5 here. And we have 1, 2. Now then 3 would be the shortest. So 1, 2 has to be somewhere here. 3, 4, 5. So it might not be exactly like this, but if that is wave 4, then that's where we would go. So which would be wiping out a lot of the value over the next couple of years. If, however, wave 4 would be here, well, it still would be a 50% drop. So yeah, we're good to go here. Yeah. Now, just need the right page from the Elliott Wave Theories, and then we can actually jump into Motive Wave. You can find most of the tools, or pretty much all of the tools that I'm using, down in the description below. One thing we have to consider, we only have a history here from 2007. So just like yesterday when we looked at the Dow Jones, we have to consider that our history basically is from here-ish. So we don't have the prior part. So if we were to label this, we would actually expect a different turnaround point. Yeah. So that's why we always use TradingView to double check our data sources. Now, I'll quickly have to restart an app here to hopefully turn on the second light. Yeah, it works. Yeah, and then we're good to go. So basically what we are saying, or what Elliott Wave Theorist is saying, okay, and that just saves so much time, which is super nice. But basically here we had our wave 5, which makes it wave 1, and now we're in the process of wave 2. The question is, where do we have that wave 2? And the answer to that is that's the weekly chart. So we're also going to look at a weekly chart. The default tool, weekly, 1 week. So, and then we zoom a little. So here we have the high. Yeah, that was the, so yeah, from here we're looking basically downwards. So, and which means from here we say, okay, this here is 1, 2, 3, 4, 5. And that's actually the same thing that got me in the other chart, that I'm having a hard time still personally to properly identify when we have like flat corrective patterns. So anyway, so if this is 1, 2, according to Elliott Wave Theorist, then that would be our base channel using Kennedy channeling technique. And again, 1 would be here because 2 up. So 1 would be here. We can extend that and at the median, which means we would now expect the breakout here. Now the corrective pattern here is actually a simple one, unlike the Dow Jones, according to ABC. Oh, I have the 0.2 wrong. Sorry for that. So A, B, and then C would actually be here, and which means 2 is also here, which means that that channel looks actually different because that's our 0.2 parallel through 0.1, and that's how our channel would look right now. So that would be how it currently looks like, which would then indicate that technically this part here would need to turn out to be 1, 2. And on first, which means then here we have another base channel 3, 4, 5. Yeah. First glance, that actually, I mean, we're on weekly, but it looks like there might be 1, 2, 3, 4, 5, and then here A, B, C, which is very, very important here. So because if we, so we can add a correction here. That's A, B, C. And yeah, why is that very important or not very important? Because it gives us a new base channel. So that base channel is from 0.0, which is here. So 1, 2, 2.2 to here with a new median up. And we basically would expect the breakout from here. Now we can also, if we look here, just to be on the Fibonacci, there we go, Fibonacci retracement, and we check that here. I know it gets confusing on the chart, but it's actually not that bad right now. You can see that in this case, we have actually a huge retracement, more than what we usually would have, but it's still fine. Now, it's also possible, at least in my opinion, but I'm not sure about that in terms of ElliottWave.com's opinion, that this actually isn't the finished corrective pattern. But yeah, like I'm gonna trust Elliott Wave Theorist on this because they've usually been right in the past and helped me to make some of the biggest profits that I was ever able to make. Now, if this is true and accurate, what we have to consider is that obviously we would expect the breakout here to the bottom with then a potential correction to the top here. We cannot go much higher because that would violate the 0.1 here. Yeah. So, and since we're in a third wave that we are kind of sub-labeling here, the third wave always has to be an impulse. So we should drop below the 1,640, and then, and in terms of how far we drop, we could take a Fibonacci extension. And can here, our profit target would be like 15,000, for example, the first one. So like this. And then the retracement for wave 4 could only take us back to 16,000. Yeah. Overall, that is actually not even relevant. So we're gonna get rid of the Fibonacci to at least keep some kind of like sense here. I'm gonna move that stuff because obviously that and that needs to move and that needs to move because obviously that wave 3 here, where's wave 5? So that's how it adds up here. Yeah. So that small wave that we have here, 1, 2, 3, 4, 5. 5 might not fall that low. I just put it there. So, but we can also actually already, since we have wave 1, 2, we can put another extension here to give us like a first profit target. It doesn't have to be that that's going to be where it's turning around, but it's like likely going to be 138.2 or 161.8 or 261.8 and so on. Yeah. So so our target here is way too low, but if I adjust it, then the rest looks like a mess right now. So we're going to just leave it like this. And yeah, it's probably going to be a very short episode today because we didn't have to figure things out on our own, but we could use, as said, like Elliott Wave Theorist for the information, which, by the way, is a subscription service that comes at, for the first month, $37 and then $111 per quarter. If you follow the link that allows you to read the free Elliott Wave Theorist book, then you can also there find the free Elliott Wave Theory book. Then you can also there find Elliott Wave Theorist. Now, the good news is for any position that we open now, so if we assume this is 1, 2, it doesn't make much of a difference since wave 2 here retraced a lot. Yeah, if wave 2 would have retraced little less, then we could use that as a stop loss. Here we can just, since the Elliott Wave Theorist does not sublabel, does it? 1, 2? No, it actually sublabels this part as well. Okay, yeah. So we can actually take this as our stop loss here. Just have to adapt it to the SRTI since it's an inverse ETF that's slightly leveraged. I assume it's also slightly leveraged because most of them are. We have to obviously adjust. So there the value will not be 1,000 something, but it will be something lower. So we'll have a very neat stop loss because if we look at the bigger picture here, so again, it's at 1, 2, then we expect a breakout from the channel. So our stop loss current price would be 1,750 roughly. And our stop loss could be, for example, here 2,030. So 2, 3, maybe 4% risk here to the upside. Of course, in the leverage ETF, that will translate to a little bit more risk. So it might be 8% risk to our position. So if we invest 10% and we round up to 10% risk, then we actually would risk 1% of our overall portfolio value if we are wrong, whereas our profit target would be beyond or outside of the, or at least on that trend channel. And as we can see, that trend channel is relatively steep. Yeah. Now, however, the minimum would be, as we said, around 14,500. So again, if we just talk in absolute points, so our risk here is 80 points, 80 price points to the top, whereas to the bottom we have 250. Yeah. So that's again like a 1-to-3 ratio. So our risk reward ratio is again great. And considering that the information came from ElliottWaveInternational.com, so literally the guys or the employees of the guy that wrote the book, on Elliott Wave Theory, or the second book after Ralph Nelson Elliott wrote the original. Yeah, it's kind of like one of probably the safest bets. Now I know we're gonna have, I'm gonna switch camera. So I know we're gonna have a lot of exposure to the markets now because we will have, we already have our 20% positions betting against the SPX and the NDX, where we've suffered throughout the year so far some temporary losses that we didn't realize. I mean, we, like realized gains, realized losses, yeah. Because, like I missed that wave 1 finished and then thought wave 2 already is done too early when it wasn't. So there was no point, in my opinion, to close or hedge those positions. So that's what's responsible for having the minus 19% right now year-to-date performance in the portfolio. However, since we now have like wave 2 finished, and also according to Elliott Wave International, wave 2 is finished, it stands to reason that now we have the turnaround. Again, there might be a couple more days, things going up, and our temporary loss might increase a little bit, maybe even to minus 25%. Before then, we actually start to develop those fifth waves. Because if we are switching back to the desktop, so if we look at the SPX, might take a moment to load, we can see that here we actually might still have a little movement. It might not go that high. It's just like what I indicated here to finish this pattern here before we then start our downwards movement 1, 2, 3, 4, 5. Yeah, I mean, it's already possible that this actually was the end of the move here. but we're going to expect it might be a little more before we go down. Now, in the NDX, we actually finished our second wave, or we are fairly certain that we finished it, yeah. So there shouldn't be much more upwards movement. There might still be a little, I'm gonna be like honest here, so there might still be a little, but it shouldn't be way too much, which means like we also will go down here. But you can see that the SPX is lagging behind, so it's like the one that's like, okay, still has a little bit more room, or maybe also already turned around here. We will see in a couple of days how things develop. And then in the NDX, we are also at that point. And if we look at the Dow Jones, there we already have our wave 2 finished and are already in wave 3 territory. So we should actually be good to go. And yeah, well, we have our up and down moves and so on. So there will be some losing days, maybe even losing months in between. But overall, the trajectory should be downwards. And since the third wave downwards, third waves are usually the strongest, which means at some point we should have a huge drop, yeah. And then in the Russell 2000, we have a similar situation that wave 2 actually, according to Elliott Wave Theory, is already finished, which means at some point we should have a huge third wave downward movement, yeah. Now it could be that this here is 1, 2, 3, so 1, 2, 3, 4, and now we're finishing wave 5. Then we would have another retracement up a little bit, and then we would have another 1, 2, 3, 4, 5, and so on. But overall, we're right now in this wave 3 downwards, according to Elliott Wave International, and we'll just have to wait it out. But the point is, on positive days, so when all markets move positive, our exposure is a little higher because, again, we have 40% total betting against the SPX and the NDX. As of yesterday's, we have 10% of the portfolio betting against the Dow Jones. And as of later today, once the market opens, we're going to have 10% of the portfolio betting against the Russell 2000, which means we're going to have 60% of our portfolio total invested betting against the market. And in combination with those 60%, we currently we have 20% in cash. So it will be 60% betting against the market, 10% still in cash, and then what's that, 5, 10, a little bit more. That doesn't check out. So 23, it's around, okay, it's because we have more than 20% invested against the SPX and NDX, so 23.45. So that's, let's say, round up, that's 50%, 60, 70%, then 10% against the Russell. Next is then 80%. And then, yeah, we will have 10% cash left and 90% invested, with the biggest position being our bets against the SPX, NDX, followed by the Russell, followed by our Dow Jones investments against them, followed by our 10% position in GameStop right now. Yeah, that should also soonish then have its fifth wave, which should get us like, yeah, a very, very decent gain. We'll have to see how it turns out. Actually, yeah, let's look closer here. Let's also go on a 2-day chart. So yeah, possibly that this, let's get a retracement here just to check it real quick. I don't think that that's 1, 2, because, yeah, I mean, the retracement goes a little bit further, but because that technically would indicate wave 3, because it's a very strong movement, yeah. So what's the low that we have here? The low that we have here is 1553, and the low that we had here is 1541. So actually this one here is lower, 1553. So it's possible that 4 is actually here, which would require a small adjustment of the channel. And then this here would probably be 1, 2, 3, 4, with now wave 5 finishing, which would then be a leading diagonal in wave 1, which then makes up wave 1, 2. If that's the case, our profit target here, or the next profit target, we're not going to take profit because we're waiting for the bigger thing to play out. But then basically, sorry, so that would be 0.4 theoretically, that would be 0.2. So our profit target would actually be along the lines of either the median here or the top here. So we would look already like at a slightly more increase, which would be wave 1, then we would have a drop, and then we would go further up and so on. Yeah, so we'll have to see how that plays out. Yeah, obviously it's also possible that the corrective pattern here is different, that this is A, B, C, for example. No, it's not possible here, because then it would need to be a combinative I don't know, that cannot be a corrective pattern here, because that's obviously fifth wave. Scratch that, yeah. So, but yeah, anyway, so in GameStop, where we have 10%, we actually also expect an upwards movement. And yeah, they announced their earnings in a week or so, so we'll see if that will trigger any kind of move. It would be a suitable earnings would be suitable to trigger something, but we'll see how it goes. Yeah. Anyway, yeah, that's it for today. Since it's first day tomorrow, there's no stream, so we'll see each other again on Monday with another episode of Daily Market Mastery. On Monday, as usual, we want to go through the portfolio and look at the progress in our positions. We'll see if until then the US debt ceiling issue is resolved by the Senate signing or approving the agreement that President Biden and House Speaker of the House, I guess, is it John McCarthy? I think it's John, yeah. If they get to sign that or not. If not, then theoretically by Monday, the US might default, which would cause a market crash, I would assume. We'll see, yeah, if it happens or if not. It's really interesting times to live in. Either way, on Monday, we'll review the progress on the portfolio. And yeah, I'm super bullish. I'm like really glad. Honestly, I'm really glad that I got the latest episode of Elliott Wave Theory because we got into price territory where I had to start to worry a little bit. Yeah, no. So like, I mean, in the SPX, it's still fine. We're still below the wave 4 here. In the NDX, we already exceeded that a little bit. So it was already price territory in the NDX where it was like, okay, have I been wrong or not here? Yeah. But now with the official count from elliottwave.com, yeah, I'm way more confident again to just say, okay, we'll wait this out. And we actually should be in the beginning of our downward trend, which is super cool because a lot of our portfolio is in that. I mean, again, if we're wrong, it's not so cool, but for newer positions, we'll have anyway our stop losses. So yeah, like cut the losses. Yeah, that's what a stop loss is. And yeah, for the rest, I'm super bullish and excited because I would expect that by the end of the year, we actually, again, outperform the markets hugely. And if we do so, it's going to be really, really nice and time to celebrate. Yeah. Anyway, so thanks for tuning in. I hope you were able to take something away from today. If not a lot, then the one thing you should take away is like check the link in the video or stream description to either read the book for free or order a physical copy. Or if you're already a little bit further ahead, like get Elliott Wave Theory so you get your like monthly to quarterly, usually quarterly updates on where Elliott Wave International thinks the markets are going and how they label the charts as kind of like a double check and additional training. And yeah, so that's it. Till next time.